and welcome to Value Research Helpline. I'm Ruchira and our experts here at Value Research are now all set to answer your queries on investing and personal finance. Joining us is Ashutosh Gupta, who heads the mutual fund research team at Value Research. Welcome, Ashutosh.
Thank you, Ruchira.
Today's first question has been sent in by Ashish Jain, who has subscribed to the National Pension Scheme, both Tier 1 and Tier 2, with 75% equity allocation. With the markets running up, he wants to rebalance to reduce his equity allocation. So he wants to know if NPS has any tax implications on that.
Well, as far as the Tier 1 of NPS is concerned, the rebalancing happens automatically once every year. That's on the subscriber's birthday, is when the asset allocation is restored. So to that extent, it happens automatically and he may not have to do anything on his own. But having said that, if someone wants to change the targeted asset allocation itself, so that flexibility is provided by NPS twice in a financial year, where one can do that. And I understand that comes without any tax implications. Now coming to the Tier 2 of NPS, the asset rebalancing over there would work by and large the same way as it does in case of mutual funds. So a subscriber would by himself need to alter the asset allocation and redeem a portion of the asset class which has run up substantially and invest in the one which has underperformed. Now, as regards the taxation on these transactions, right now there is not enough clarity from tax authorities on the tax treatment of the capital gains that one derives from Tier 2 of NPS. But since securities transaction tax is not paid on these transactions, so a lot of investors prefer to assume or treat them like a non-equity investment for the purpose of taxes. So, from that perspective, a lot of investors prefer to calculate capital gains tax the way they would do on a fixed income fund. So that's what the current stand is. But ideally, more clarity is expected on this from the tax authorities.
All right, now the next query has been sent in by Mayank Khemka, and he asks, in the current market scenario, can a fund manager sell equities and sit on some cash, or are they compulsorily required to remain invested in equities only?
Well, if we go strictly by the investment mandate, which is written in the scheme information document of equity funds, well, then the fund managers do have the flexibility to move a portion of their assets in cash and equivalents. That's on what the stated allocation permits them to do. But in reality, the experience is that very few fund managers move into cash, and most of them prefer to remain fully invested. So barring say 2 to 5% of cash allocation that may be there in a fund in a steady state, beyond that, fund managers deter from taking any active cash calls. In fact, also in case of the few funds where time and again one sees a significant buildup of cash, those fund managers don't really attribute it to an active call on the markets that they are taking, but rather they suggest that that cash buildup is because of continuous inflows in the fund, and the fund manager not being able to find enough promising stocks at the right price. And this typically happens in runaway markets, where a fund manager may not find enough opportunities at the right price to deploy all those incremental inflows, which can lead to a buildup of cash in the portfolio, which then subsequently gets invested over a period of time. So yeah, a lot of investors, a lot of fund managers do not take a very active cash call. And in fact, there's a lesson there for retail investors that if fund managers avoid trying to time the markets, then for retail investors, the chances of hitting success by actively trying to time the markets is even slimmer, perhaps.
Now, Meenumati wants to know the difference between credit risk funds and corporate bond funds. Which one is safer to park funds intended for SIPs?
Well, it's the credit quality of the underlying portfolio that creates a material difference between corporate bond funds and credit risk funds. So by their investment mandate, corporate bond funds have to invest at least 80% of their assets in bonds of the top quality, bonds rated AAA. While in sharp contrast to that, credit risk funds have to necessarily invest at least 65% of their assets in bonds which are less than top rated. So there is a material difference between the underlying holdings of these funds. And of course, credit risk funds happen to be a higher risk, high return strategy. Now, what do I mean by credit risk is that these funds invest in bonds of issuers which have a relatively weaker financial standing. And these are the kind of issuers in case of economic downturns, they are more vulnerable to defaulting on their interest payments or principal repayments. And to compensate for that risk, they have to offer a high rate of interest on their bonds. So that's why credit risk funds are better placed to offer better returns. But of course, that comes with a higher risk. Now, coming to the second part of the question around SIPs, well, I would believe that neither of these two categories are an ideal one to set up your SIPs from. For that, I would suggest funds like liquid funds or maybe even ultra short duration funds, which are far safer on all counts, be it credit quality, be it liquidity, be it responsiveness to the ups and downs in the interest rates, the volatility that comes with it. So on all these measures, liquid funds and ultra short duration funds are far safer, and as per me, much better suited categories to set up your SIPs from.
The next question has been sent in by Ramesh. He's investing in a few actively managed large cap funds and also in NPS Tier 1 for his retirement corpus. Ramesh finds their returns to be almost similar. So should he remove all his money from NPS Tier 1 with a 75-25 allocation?
Well, I would suggest him to keep a fair mix of both mutual funds as well as NPS in his portfolio. While of course NPS is a good product and their ultra low costs is one of their biggest advantages, but they come with certain restrictions. One is that for all practical purposes, they are fairly illiquid till the time the subscriber turns 60 in age. While there are certain circumstances under which NPS does provide liquidity in the interim, but it comes with a lot of conditions. So as I said, that for all practical purposes, one has to assume the NPS allocation in his portfolio to be illiquid till the time one attains the age of 60. So that's one. The other is that even at the age of 60, when one redeems from NPS, at least 40% of those redemption proceeds have to be necessarily used to invest in an annuity product. So that adds another restriction to what you can do with your accumulation from NPS. In contrast to that, mutual funds do not come with any such restrictions. They provide superior liquidity, of course, and also there are no conditions on the way you need to utilize the redemption proceeds or your accumulation. So I would suggest that he should keep a fair mix of both of them in his portfolio. And really to lower his cost, since anyways he's investing in large cap stocks, what he can do to lower the costs is to start investing in index funds, the passive funds, instead of actively managed funds. And that could lower his costs even on the mutual fund side.
Srijan Singh wants to know which debt funds are better for 12 years investment horizon, dynamic bond funds or 10-year gilt funds?
Well, that's a tricky question. And I think the answer would be much more complicated than giving this or that category of funds as an answer. So let me try to provide my perspective and the way I would approach this. What I believe is that for the core fixed income allocation of any investor, a bulk of that money should be invested in short duration funds. And more broadly, since long, we at Value Research have believed that by and large, the only two kinds of funds that any fixed income investor needs are liquid funds and an income fund. Of course, liquid funds are meant to park your emergency corpus or any money that you need within the next 1 year's time frame, while an income fund could be the one which is meant for your more steady state fixed income allocation. Now, the tenets that one should expect from this income fund would be of returns which are reasonably better than a fixed income over an investment horizon of, let's say, 2 to 3 years or more. And these returns, this fund should be able to generate without exposing the investor to any unwanted credit risks or too much of volatility with respect to the movements in the interest rates. Now, if we try and find out these tenets among the 16 categories of debt funds that are available these days, we believe that short duration funds come closest to playing the role of this classic income fund in an investor's portfolio. And that's why I believe that a bulk of an investor's money, or potentially all of the long-term fixed income allocation in one's portfolio, can be invested in these short duration funds. Now, of course, there would be times, there would be periods when these funds are primed to generate very low returns. And we are anticipating one such phase in the near future, in the, let's say, the next 1 year, where the returns of these funds may not be very substantial, more so in the context of the kind of returns they've been able to generate in the last 1 year. Now, some investors might be okay to live with that, ride through these periods of relatively lower returns with these short duration funds. But some other investors who would want to enhance their yields a little bit, now they have two options in front of them. One is that they assume a little more credit risk by investing in products like credit risk funds to generate or to boost the returns from their core allocation in short duration funds. Or the other approach that they can take is to add a little bit of duration to their portfolio. By that, I mean investing in funds which hold longer maturity bonds and which can yield slightly better returns. Now, out of those two approaches, we believe that it is not very desirable at this stage to take too much of credit risk, because economy is still in a recovery phase and the credit environment is still unfolding. So we believe it's avoidable to expose yourself to too much of a credit risk at this point in time. Therefore, a more viable approach to enhance your returns from fixed income allocation at this stage appears to be adding a little bit of duration to your portfolio, more so in the current context when the yield curve is very steep, which means that the relatively longer term bonds are yielding more attractive returns in the context of what short duration bonds have to offer at this point in time. So from that perspective, adding a little bit of duration to your fixed income investments may be a more viable approach at this point in time. And for that, one can look at adding a measured dose of products like dynamic bond funds or even certain corporate bond funds, which do offer those longer term maturities to one. But one should remember, by doing that, they would be also assuming a relatively higher degree of volatility in their portfolio, because these funds can be more responsive to the ups and downs in the interest rates in the economy. And in fact, investors may also need to manage these allocations a little more dynamically and consider shifting out of them when the interest rates start to increase. So to sum it up, what I'd suggest to him is to look at short duration funds to form the core of his fixed income allocation. And in case he wants to enhance his returns a little bit, then probably look to add a little bit of dynamic bond funds or some select corporate bond funds in a measured dose, but be willing to accept slightly high degree of volatility that would come with it.
AK Malik hasn't received any dividends from his ETFs like he does from mutual funds. So what happens to the dividends they receive from underlying companies is what he wants to know.
Well, most ETFs reinvest the dividend proceeds that they get from the underlying securities that they hold back into the ETF itself. In India per se, there are very few ETFs which have any history of paying dividends. There are just a handful of them. And the ones that do, the mechanics are pretty similar to the way dividend is distributed in case of a stock. They typically they announce a record date, and the investors who are invested in the ETF on the record date would be eligible to get those dividends.
A.S. Khanvilkar wants to know your view on the future of Mirae Asset Emerging Blue Chip Fund, as investment in it is now restricted to not more than 2,500 rupees.
Well, Mirae Asset Emerging Equities Fund happens to be among the better large and mid cap funds. It has been among the most consistent performers in its category. And going by the track record of the equity franchise or the investment management team at Mirae, one would hope and one would expect that the fund continues to rank among the better ones and continues with the consistent long-term performance record that it has been able to build. Now, of course, as he rightly pointed out, the fund has restricted fresh inflows to not more than 2,500 per month, from an investor. And the fund has done that in the interest of existing investors, because this fund invests substantially in mid-cap stocks, and the fund already has a very healthy SIP book build up. So the fund wants to have a greater control on incremental inflows that the fund receives from here on, because the investment management team is of the view that if they continue to receive substantial proportions of incremental inflows, then they may not be able to deploy them speedily enough, given the already big size of the fund. And if they are not able to deploy that money speedily, then that could be to the detriment of the interests of the existing investors, as it could hurt the performance. So that's why they have taken that call to restrict the incremental inflows in the fund. Now, of course, that may put this fund out of contention for certain investors who invest a sizable amount every month through SIPs, because by investing even to the maximum of 2,500 per month in this fund, it may end up being a very small allocation and may not contribute much to the overall returns. So for those kind of investors, this fund may be out of contention for now. But otherwise, the fund continues to be among the best ones that are available in the mid and large cap category.
All right, now Joseph Samuel asks, how do sovereign gold bonds compare with gold ETFs? Are SGBs a better option?
Well, yes, I would say that investors who are looking to invest in gold, for them, sovereign gold funds appear to be a superior option to gold ETFs on a lot of counts. So let me talk a little bit more about them. Talking about returns, sovereign gold bonds offer a 2.5% per annum rate of interest over and above the appreciation in the price of gold, which these bonds would fetch. While in comparison to that, gold ETFs only fetch you the appreciation in the price of gold. So of course, there is a clear 2.5% extra return that you can make from sovereign gold bonds vis-a-vis the gold ETFs. That's one. Second is around the costs. So sovereign gold bonds really do not have any ongoing cost of ownership, while gold ETFs have an expense ratio of typically around 1%. So that's a cost that investors who remain invested in the gold ETFs have to pay. So there as well, SGBs trump over gold ETFs. Now, the third aspect where SGBs are miles ahead of gold ETFs is the taxation. Because in case of SGBs, the appreciation in the gold, the capital gains that you make on the appreciation in the price of the gold is completely tax free. You only have to pay tax on the 2.5% interest, which gets added to your income and gets taxed as per the slab system. In contrast to that, in case of gold ETFs, you have to pay capital gains tax on the price appreciation of gold that you achieve, and they are taxed as a non-equity capital gains. So there again, SGBs are miles ahead, as I said. Now, the only aspect where SGBs trail behind gold ETFs is the liquidity, because in case of SGBs, liquidity is for all practical purposes unavailable in the first 5 years. After that, you can redeem them directly with the RBI, but in the initial 5 years, you can only sell them on a stock exchange. While the practical experience is that these bonds usually do not have a lot of liquidity on the stock exchange. So you have to live with a lower degree of liquidity in the first 5 years. Now, in contrast to that, gold ETFs, or at least some of them, have fairly robust liquidity. They trade in fairly robust volumes on stock exchanges. So in case of those gold ETFs, liquidity may not be much of an issue. So to sum it up, if for an investor for whom liquidity is not a big concern, then certainly SGBs look like a better option.
Kishore Kumar wants to know if value research can state the reason for upgrading or downgrading the rating of any mutual fund scheme.
Sure. Well, first of all, rating is a purely quantitative measure which is based upon a fund's performance relative to its peers. And what follows from that is that by and large, the only reason for a fund to be upgraded and downgraded is its relative performance compared to other funds in the same category. So if a fund delivers superior performance relative to its peers, it stands a chance to be upgraded, while on the flip side, if a fund trails behind its peers in risk-adjusted performance, then it stands a chance to be downgraded. So much so that you might come across funds where you see that a fund has significantly outperformed the broader market, and yet it has been downgraded. Now, that is very much possible in cases where, while the fund has done well, but its peers have done even better. They have beaten the market by an even wider margin. And in that case, even after beating a market handsomely, a fund might be subjected to a downgrade. And similar is possible on the flip side as well, where a fund might have comprehensively underperformed the broader market, and yet it witnesses an upgrade in the rating. And again, as I said, that the reason could be that while the fund has underperformed, its peers have performed even worse than this fund. And that is a case where, despite underperforming the market, a fund may get an upgrade in the rating. Now, talking specifically about how the rating itself is calculated, for equity funds, we use time frames of 3 years and 5 years to measure their performance. So we assign what we call as a risk score to every fund, which is based upon the returns generated by a fund relative to other funds in the category. And we also assign a risk score to every fund, which is basically the risk of underperforming the risk-free rate. And for our purposes, the risk-free that we use is the rate of interest offered by the shortest tenured fixed deposits of State Bank of India. So we calculate the return score and the risk score, and we subtract the risk score from the return score to arrive at the composite score of a fund. And basis the composite score, we rank the funds in the descending order in a particular category, and assign a 5-star rating to the top 10% of the funds, a 4-star rating to the next 22.5% of the funds. The middle 35% get a 3-star rating, and likewise the next 22.5 and the bottom 10% of the funds get the 2-star and the 1-star rating. So that's the mechanics of how the ratings are calculated. And as I explained, the reason for any upgrade or a downgrade in rating is by and large linked to the relative performance of a fund vis-a-vis its peers.
Okay, now Jagadish Raila says NAV of Axis short-term debt fund fell by 0.21% in a single day earlier this week. Is this unusual? He has started investing in this fund recently but is not comfortable with such dips. So should he pull out his money?
Well, he's correct. Axis short duration fund did witness a sharp one-day fall in its NAV, but this fund was not alone. All short duration funds witnessed a sharp drop in the one day NAV, and that's because it was driven by market-wide factors and not anything unique to this fund. In fact, if you look at the category, about half funds fell by a magnitude of about 20 basis points, while the worst one fell by about 32 basis points. Now, whether this is unusual or not, I'd say that such one-day falls of this magnitude are not very frequent, but it's not that they are completely unheard of either. So if you look at the last 5 years or so, there would have been about 18-20 such one-day periods when short duration funds would have experienced negative returns on an average of a magnitude of 15 basis points or more. So while this is an infrequent phenomenon, but this is not unheard of. Now, whether he should redeem from these funds or not, I don't think so. If his investment horizon is say more than 1 year, then he should not be too worried about these one-day ups and downs, because while short duration funds happen to be relatively safer in contrast to many other categories of bond funds, but they are not completely insulated to the ups and downs in the bond market. And if there are any sharp knee-jerk reactions that happen in the bond markets, these funds are bound to be impacted by them. But as I said, that if he has a horizon of more than 1 year, then he should not be too worried. The other thing I like to point out to him is that in at least in the next 1 year, his expectations of returns from these funds have to be much more moderate. So if you look at the past, these funds have delivered 9 to 10% returns in the last 1 year. But if you look at going forward the next 1 year, these funds very likely will not be able to deliver these kind of returns. So from the next 3 to 4 quarters perspective, probably 5.5% returns would be a much more reasonable expectation.
Kirti Prakash has long-term capital loss after indexation on debt funds. Can she set it off against long-term capital gains from equity?
Yes, sure. The tax laws permit the long-term capital gains to be set off against long-term capital loss. So she can use the long-term capital loss on her debt funds to set off the gains that she has from equity. Not only that, if she's not able to utilize all these losses completely to set off some of the capital gains, then she can continue them and take that benefit up to the next 8 financial years.
SK Sinha has invested 60% of his money in bank FDs and 40% in mutual funds, but over time, mutual funds have grown faster, so the proportion is now 50-50. So does asset reallocation mean that he should redeem some mutual funds and transfer that money to FDs?
Well, yes, his understanding is correct. Asset rebalancing means that you start with a certain targeted asset allocation in mind, and you divide your money across those different asset classes in that target allocation. And over a period of time, some asset classes do better than others. They yield better returns than others. And by virtue of that, their proportion in the overall portfolio increases versus the others. So asset rebalancing basically means that you sell the assets which have run up substantially and whose proportion has increased much more than what was intended. And by those sale proceeds, you buy the assets whose proportion in the overall portfolio has dropped, so that you are able to restore the original asset allocation that you started with. Now, asset rebalancing has a couple of important benefits. One is, as I said, that it helps you restore back to a position on the risk return spectrum which you started with. Because let's say you started with a equity debt allocation of 60-40, and over a period of time, equity has become 80% of your portfolio, while that has dropped down to 20%. Now your portfolio has become riskier and prone to sharper ups and downs with the ups and downs in the equity market. And you might not want, a conservative investor might not want to experience that kind of volatility in his investments. So restoring back the 60-40 through rebalancing would help him restore that parity. The second important function that asset rebalancing does is that it naturally helps you buy low and sell high. Because if you think about it, while doing your rebalancing, you are selling the asset which has run up substantially, while you are buying the asset which has underperformed. So what is inbuilt in asset rebalancing is that you buy an asset low and sell it high. And that's really what one wants to do with his or her investments. But the thing about asset rebalancing is that you should not try to do it too often. Perhaps you can aim to do your rebalancing once a year, or as and when your asset allocation deviates from the intended one by more than 5%, maybe that could be the right way to go about your asset rebalancing.
Today's last question has been sent in by Nikunj Jalan, and Nikunj wants to know, why are liquid funds not performing well? Should he hold them or withdraw and invest in FDs?
Well, liquid funds are not yielding as much returns as they used to until the recent past because the interest rates have fallen substantially. The interest rates or the yields, particularly on the short duration, very near-term bonds, are fairly depressed these days. And therefore, while up till recently they were able to offer meaningfully higher returns than a savings bank account, but in the recent past, that margin has dropped down substantially, and these days they are yielding by and large similar to what a bank account would fetch. So just look at this graphic on your screen, where you see how over a period of time the yields offered by liquid funds has dropped substantially to now be in a touching distance with what say a savings bank account in State Bank of India would have to offer. That's a function of the way debt markets are these days. Now coming to his second question, uh, I'd say that if he has more than 1 year of investment horizon, which he likely has because he's talking about shifting this money into a fixed deposit. So if he can invest this money, if his investment horizon is of more than 1 year, then I'd say that liquid funds is not a suitable category of funds anyways. In that case, he should look to move this money to short duration funds, which can yield better returns. And over a time frame of say 2 to 3 years, short duration funds can also yield potentially better returns than what an FD can fetch. So perhaps short duration funds would be a better category of funds for him to look at.
All right, then, with that, it's a wrap on this episode of Helpline. Thank you, Ashutosh.
Thank you.
Thank you to all our viewers. You can go to VR Helpline on Value Research online and send us the questions that are stopping you from investing today. Our team will answer them in the upcoming Q&A session. Bye for now.